Hello and welcome to MF Corner. I'm Sumaira Abidi. As investors, we give outsized importance to the equity portion of our portfolios, but it's time we take the debt portion seriously and look at crafting an optimized debt portfolio. Even within debt, we have taken great pains to understand credit risk. Perhaps because it was thrust in our faces, but not many are familiar with the nuances of the duration and the interest rate risk. So get ready for a masterclass. Suyash Choudhary, head of fixed income at IDFC Mutual Fund, now joins in. Hi, Suyash. Thanks very much for joining in. The basic premise that we have of a duration fund is that it invests according to the life of the bond. I mean, to put it very, very simply, right? But surely that's not the only variable. So how should a retail investor understand the prevailing interest rate scenario and the often sharp movements, in the bond yields vis-a-vis their funds? And, we've seen a very, very recent example post the budget too. So what is the best way for an investor to look at it?
So thank you, Sumaira, for inviting me today. Absolute pleasure to be able to interact with you and your audience. Let me start by saying there is a repeated tendency, in our market for people to overconsume certain product classes. And by which I mean, it may lead back to the unavailability of a robust asset allocation table. But multiple times we have seen with respect to both duration as well as credit risk products that they have been over allocated to. And therefore, short period pains, sometimes morphing into longer period pains that emanate out of those, then tend to cause a serious amount of damage. Case in point being, it's not so much what is astonishing, the fact that credit risk funds in some part have deteriorated in value. What is more surprising is the amount of portfolio pain that it has caused for investors, which also leads back to the fact of over allocation. So I think, a starting point, whether you think about duration products or credit risk funds, is a robust asset allocation table where you slot the product and the amount you are going to consume or invest of it in the right proportion. Look, as an environment, we are at the bottom part of a rate cycle, and therefore one has to expect modest returns from all products within fixed income. It is not also necessary that in this phase you will beat expected inflation, because we are at the point of a macroeconomic cycle where the consumer is being incentivized at the expense of the saver, and this will change down the line. So one of the mandates for today would also be to accept a certain lower or more modest level of return, but at the same time to be very cognizant that one is not overstretching oneself on a risk.
Suyash, this acceptance of a lower rate of return, as fleeting as it may be, seems to be a very, very difficult concept, right? And in fact, do you think that people are becoming, more prone to taking risk because of this?
Absolutely right, because, over and over again, we see that as the risk-free rate tends to fall, and sometimes even if the risk-free rate is at a reasonable, level, we have seen a propensity to continually dilute one's risk appetite, or rather expand one's risk appetite and dilute one's risk perception in the hunt for yields. So yes, today you are in an environment where the risk-free rate is quite low, and therefore, rather than accept market returns for the most part, there is an endeavor to basically expand on risk appetite, which if done consciously is very good. But many times, people end up doing it subconsciously. Also, this so-called positive real return concept, gets talked about a lot. But for example, there was a full 3-year period, 3 or 4 year period starting somewhere around 2014 onwards, where inflation was secularly on a low trajectory, and you had positive real returns from even quality fixed income. Ironically, the bulk of over allocation to credit risk funds exactly happened in that period of 2013-14 to 2017-18. So what one also has to guard against is the convenience on narrative that sometimes, we tend to latch on. And like I said, it's not necessary that at all points in time one gets positive real returns from fixed income. many times, even the way we look at this concept is utterly wrong. So, there's a tendency to say that, oh, the last CPI print was X and, the current yield on a portfolio is Y. So my real return is Y minus X. That's absolutely wrong. So, positive real returns are your expected return minus expected forward inflation. And in this country, you can't measure forward inflation. And therefore, that concept itself, beyond a point, you cannot think about too much. Having said that, it is obviously nobody's case that fixed income is at a particularly attractive level right now. But, like I said before, this is a phase in the macro cycle. You can control the level of risk that you run. You can't control the level of return that the market gives to you.
Yeah, absolutely.
And that is where an asset allocation table may come in very handy.
And this is really, the concept that debt shares with equity too, right? The only thing you can control is risk. But Suyash, let's talk about, the environment may not be ideal right now for debt funds, but, what are the funds that would work best, right? You've chosen to launch your floating rate fund in this environment. Is there a reason you have chosen this environment? And, we've also received some queries on floating rate fund, Raging Critic, and, he writes to us quite often. He's one of our regular viewers. He wants to know, can he invest about 2 to 3 years in floating rate funds instead of the traditional debt funds, and how are they impacted by change in interest rates? So if you can explain a little bit about the premise of floating rate funds and where they stack up compared to the other funds in this category.
So, I would start by saying that it is almost a convenient narrative that, look, a floating rate fund is coming along just when interest rates are bottoming out. Let me assure you that is not the intent at all. And in fact, if you look around you, so for example, the last month and a half have seen extraordinary volatility in fixed income. Just see, how floating rate funds have managed to navigate that. And you will find that, not particularly very well. And the reason is essentially also this, that ultimately what matters is the net duration that you're running in a fund. So, no matter you are running a fixed rate instrument, which you have swapped for floating rate instrument, or you're running floating rate instruments themselves, if your net duration is positive, that is the unit of risk, and that will determine how your NAV fluctuates in response to changes in interest rates. The second point to remember is that in India, the availability of pure floating rate instruments is quite constrained. And therefore, whatever exists with a reasonable amount of liquidity risk as well. The third fact is that if you were to convert a fixed rate instrument to floating rate by using interest rate swaps, you carry a reasonable amount of what is known as basis risk, which means that there is a tendency many times for the bond yield and the swap yield to move not in tandem. And therefore, this may not prove to be an actual pure hedge at all. So, let me clarify, it is not really the turn in a rate cycle that is our incentive for launching a floating rate fund. On the IDFC platform, the one thing that we take very seriously is to be able to create products that plug into a robust asset allocation table for investors, which is why we think about products in 3 buckets: liquidity, core, and satellite. Liquidity is for your cash management needs, so your overnight liquid funds, etc. Core bucket of products is where you take constrained amount of duration and credit risk. So this is the bulk of your fixed income allocation most of the times. And satellite products are where you take higher amount of credit or duration risk. So all your active duration and passive long duration funds as well as credit risk funds fit there. The floating rate fund from us is a satellite bucket offering because it's meant to pursue a slightly more diluted credit strategy in the category of, the risk profile of maturity of low duration, kind of risk profile. So low duration to short-term risk profile, but it will run a diluted credit strategy. And that is the motivation for launching this product, not necessarily any flag on a change in the rate cycle, which is an independent discussion altogether. So I'm not saying it's not changing, but there are multiple nuances to the change in the rate cycle, which is often not understood very clearly.
Suyash, can you explain this diluted credit strategy a bit? Because, what happens when investors are looking at, especially duration funds, is that because there is so much overlap and, then you have this whole concept of Macaulay duration, because even a short-term fund will have funds which are very long, bonds which are very long duration, etc. An investor, is not wrong to get confused in choosing the product, right? So if correct me if I'm wrong, the floating rate fund differs therefore from its duration peers in the credit risk that it takes on?
So one of the objectives to work of core satellite principle is to be able to clarify the trade-off that exists in front of the investor. See, many times how we fail our investors collectively as a community is to present, maybe subconsciously, and I would include the advisor community here as well, we present false trade-offs sometimes. We say that you can have the best of both worlds, so you can get a higher YTM and you can get very, very good portfolio quality, whereas in the real world, that trade-off simply does not, or that correlation does not exist. So as yields go higher, portfolio necessarily gets diluted. Now, the floating rate fund that we are doing, what we are proposing to do is that at the point of investment, minimum 70% of the fund will be in AAA, A1 plus, equivalent, sovereign, etc. And up to 30% at the point of investment can be in lower rated, with one condition that we won't buy anything lesser than AA minus, again at the point of investment. So you can clearly see that this is a diluted credit strategy, which means that it is meant for investors to allocate in the satellite bucket. So the duration is not possibly going to be very different than, let's say, a front-end product, like a low duration or a short-term kind of product. But the difference compared to our core bucket offerings. So for example, the difference, let's say, between our own low duration and this would be that this pursues a slightly more diluted credit strategy.
Got it. Okay, let's take a quick break. We have a lot more, to understand and discuss with Suyash, primarily how to structure that debt portfolio and how to ensure that it is optimized. All of that is lined up on the other side of this break. Stay tuned.
Ta-da! Which one's used tonight? Champagne or black?
Both champagne and black.
To evolve is a human thing. The new evolved MG Hector, now with dual tone interiors. MG Hector, it's a human thing.
कभी कभी मेरे दिल में ख्याल आता है कि जिंदगी में रोटी कपड़ा और मकान के साथ साथ बीमा भी जरूरी है।
A customer awareness initiative by Star Union Dai-ichi Life Insurance.
Attic fittings make your furniture work beautifully. German quality you can trust.
हेलो, सस्ता ब्रोकरेज डन करो।
सस्ते के चक्कर में पड़ जाओगे बीमार। चुनो सिर्फ स्वस्तिका इन्वेस्ट मार्ट को। टॉप रिसर्च टीम, पैन इंडिया प्रेजेंस और 28 सालों का अटूट विश्वास। स्वस्तिका इन्वेस्ट मार्ट। सस्ते पर मत जाओ, किफायती और भरोसेमंद सर्विस पाओ। इन्वेस्टमेंट सिक्योरिटीज मार्केट आर सब्जेक्ट टू मार्केट रिस्क।
फर्नीचर सिर्फ सेंचुरी लैमिनेट्स और प्लाईवुड से बना है। इन दोनों में है वायरोकिल टेक्नोलॉजी, जिसके एक्टिवेटेड नैनो पार्टिकल्स वायरस को मार गिराते हैं। सेंचुरी लैमिनेट्स और सेंचुरी प्लाई।
Congratulations, Rahul.
Thank you.
आज से ये चेयर तुम्हारी।
It's an honor, sir. But sir, इतनी बड़ी जिम्मेदारी, पता नहीं स्टाफ मुझे पसंद करेगा कि नहीं।
तुम उनका ख्याल रखोगे ना राहुल, तो वो तुम्हारा और कंपनी का ख्याल रखेंगे। Here's a good way to show you care. LIC's pension and group scheme. Pension, gratuity और retirement benefits आसानी से मैनेज करता है।
मतलब एम्प्लॉइज खुश तो कंपनी भी खुश।
Hi, welcome back. You're watching MF Corner, and with me I have Suyash Choudhary, the head of fixed income at IDFC Mutual Fund. So Suyash, we've spoken a little bit about, how to understand duration funds, etc. But, one of the big stumbling blocks that happens is that people don't know how to make or how to create a debt portfolio, right? In equity, we know there are so many rules of thumb, your age minus 100 minus your age is equity, etc., etc. Within that, they know large cap, mid cap. Not enough has been spoken about how the debt portfolio should be constructed, right? So let's say, for example, a conservative investor. What should their debt allocation be like? And within that, what are the different buckets?
So, let me quickly start with addressing why do you need debt at all? Or, more broadly, why do you need fixed income in your portfolio? And the simple reason is that both economy and financial market cycles are boom and bust cycles. These are age-old and will continue for as long as, investing exists. So, therefore, you need both pro-cyclical and counter-cyclical assets, which means that you need exposure to assets that do well when you are in a expansionary greed phase, and you need protection when there is a bust or contraction. Typically, equities, real estate, etc. would be your growth assets, and quality fixed income will be your counter-cyclical, giving you basic running income when the chips are down, so to speak. And that is how debt or fixed income broadly fits in your portfolio. Second aspect is that we need to cut away some of the action bias that we continually see around us for two reasons. One is because information is imperfect, and therefore for every investor to react proactively is going to be difficult. And second, there are tax considerations, and which is why an asset allocation table in debt is relevant. Now, if you are a debt investor, the starting assumption, therefore, is that you are wanting to create counter-cyclicality in your asset allocation, which means that you are wanting some running income when the chips are down. And which is why we think about debt in three categories: liquidity, core, and satellite. Liquidity is only for your cash management needs. It's not really for investing. There you take, liquid funds, where also you should not focus on YTM, but really it's a cash management product. Core products are where you take constrained amount of duration and credit risk. So remember, the only way a mutual fund can offer a low risk profile product is by controlling the risks that come in fixed income investing, which are chiefly credit and duration. Of course, illiquidity risk is also one risk. And then there are satellite products which are meant to create some amount of so-called alpha to your total returns, where you take a higher duration or higher credit risk. Now, for a conservative investor, and assuming that the liquidity bucket is depending upon their cash management requirements, suppose 100 rupees is going into fixed income investing between core and satellite, I would assume 60 to 70% should go to core, and the balance should go to satellite, within which you can split between active duration and credit risk. Now, depending upon your assessment of where you are in a financial market or economic cycle, you can tweak this on the margin. Unlike this, most of the commentary that you hear around is that, oh, now it's a good time to get into credit, now is a good time to get into, short term, etc., which almost assumes that the investor is hugely flexible and is blessed with perfect information and can move around at the touch of a button. So I think unless we evolve the discussion and cut this, activity bias away, not to say there should be zero activity bias, but, anchor this to an underlying framework, we won't be doing too much service to the retail investor.
Yeah. Okay, so basically invest and then, let the investment work for you. I mean, don't tangle with it before it has had a chance to do its work. Okay, so you're taking this point forward of the debt portfolio. Is there a way in which, like you said, core, satellite buckets, so that is what the, largely where you have made your investments, right? Within that, when you're selecting funds, is there a way to sort of, ladder your maturities? Or, I mean, I know that all of you fund managers use that. Can retail investors also use this concept to sort of optimize the working of the portfolio?
So you're right. What an investor can do is your minimum investment horizons will be different irrespective whether you are in a core or a satellite bucket. So there are products in the core bucket that cater to, let's say, a minimum investment horizon of 6 to 9 months, which are your, money market and low duration products. There are products that cater to a minimum investment horizon, which is longer, 2 to 3 years, which could be your short-term corporate bond banking PSU kind of products. And similarly, there are products meant for different minimum investment horizons in the satellite bucket. The important point I would make is that beyond a point, these terminologies are irrelevant. So when I speak about these products, I speak about them the way we construct them. But as you know, you may find, let's say, a medium-term fund which is mirroring almost a credit risk fund profile, and yet it is called a medium-term fund.
Yes.
So, I can't speak, I can't slot the entire universe of funds available by their names into core and satellite. But really, when investors are looking to build a core bucket, they should ask the manager and the fund house how the duration and credit risks are getting constrained in those, and then ladder their minimum investment horizon. As a fund manager, sometimes one thing that has been less appreciated is that you can't fall into a trap of liability tranching. So we have seen historically, some credit risk kind of products saying that, oh, this amount of, investor redemption is protected by exit load. So I will ladder my asset maturities so that the first round of load, I have some maturities coming on the asset side. We think this is a balance sheet concept. This concept cannot be applied to a flow product like a mutual fund. So, in a mutual fund, as, recent history has shown, you can pay exit load and get out. And therefore, the manager has to consider liquidity risk into the entire equation, unless it's a closed-ended product offering. So even though, for example, in money market kind of products, we always ladder maturities because there are pressure points on redemptions. And therefore, that's an accepted investment practice. It's a legitimate investment practice. What I'm saying is that to rely on, for the entire portfolio, a sort of laddering on the asset side because you are protecting redemptions through exit load is an irrelevant concept as far as a mutual fund product is concerned.
Got it. Suyash, thanks very much for this masterclass. I really enjoyed it, and I hope those watching it too, and all the very, very best for your NFO. With that, we'll wind up on MF Corner, but not before, this thing that I remembered. I've heard a lot of fund managers say it, and Suyash has once again reminded me of this quote where they say that, we're not in the business of delivering returns, we're in the business of managing risk. And this, is something that has stayed with me, and I hope that when you're making your mutual fund investments, this is something that you also think about. Thanks very much for watching. Stay tuned. Closing bell is up next.
Presented by